Hey everyone, welcome to Coffee and Connections. My name is Daniel Bayman. I'm a partner here at Good Coffee, and today I have Miss Deanna Smith. She is a certified wealth strategist and a financial advisor with the Investment Center at CBC Bank. How are you doing today?
I'm doing great, thank you.
Well, we appreciate you coming on, and I guess just to get started, I'd like you to kind of fill us in on a little bit what you do at CBC Bank and also a little bit about your personal life.
Absolutely, well thanks, I really appreciate being here. As Daniel said, my name is Deanna Smith, and I am actually originally from upstate New York. I'm a transplanted Yankee. I lived there until I was 19, and then I moved actually to South Georgia in 1997 after a brief stay a 3-year stay in England. And I started my career on the commercial banking side with a large corporate bank here in Valdosta, assisting large corporations with their complex banking and financial needs. And I covered most of the South Georgia market, pretty much from, central and south from Macon down. And I spent just shy of 20 years with that company before I moved over to CBC Bank and into the financial advising world. I absolutely loved the challenges and the complexities of working with the larger companies because they were anywhere from 5 million to 100 million in annual sales. But I really missed making that personal and tangible impact on my clients and small business owners and individuals. And so moving over from a large corporate bank to a small local community bank has just been a world of difference. I absolutely love it. CBC Bank is so supportive and encouraging of me going out into the community and giving of my time and talents in the community, not just with financial planning, but in a lot of other areas as well. I'm a board member of the Valdosta Rotary Club, and I'm the chairperson of their literacy fund, and I'm also the district liaison for our club's education and literacy efforts. I'm also on a couple of other boards. I serve for Leadership Lounge on their board, and I'm also on the fundraising board for the Hospice of South Georgia. I'm an ambassador for our great Chamber of Commerce, so I'm excited to be partnering with them on this. And I also volunteer at the Boys and Girls Club. I lead a program there called the Academy for Success, which was born out of a community service project through the Leadership Lounge class of 2019. I am married. My husband is Terry Smith. He's a native of Nashville, Georgia. We've been married for 18 years, and I have 2 stepdaughters, Laura and Tara Smith. They are both graduates of Valdosta State University. And we have 1 daughter together, Katie. She's 16 years old and she's a junior at Open Bible Christian School. And I'm actually only a few years ineligible for the Valdosta Young Professionals Club. So I am not too far removed from some of the listeners that are in this program. So I understand. It's not been that long ago that I've been in your seat. So.
Well, awesome. Yeah, I was reading through your bio before we came on here, and so the past few years I've been really focused on the business side of it, and one of my goals I just turned 30, from 30 to 35, is to be more involved in the community, partly through the Valdosta Young Professionals, but it was definitely an inspiration to see everything that you've poured back into this community as you've been here, and I know CBC has been a big help in that, and they're very involved in the support of small businesses and our local community, so we appreciate it.
Yes, absolutely. I love being able to do it.
Awesome. Well, let's go ahead and get started. If you could just give us a brief rundown of financial planning for young professionals, and then we'll get into a little bit of a question and answer portion.
Yeah, absolutely. That'd be great. So the majority of the Valdosta Young Professionals, you guys are in between the ages of 20 and 30 and up to 40. So a lot of you are probably being introduced to the realities of adulthood and the financial aspect of that. You're having some financial responsibilities come your way. Your age group are really facing a very unique set of challenges that a lot of other generations haven't faced. You have an extremely competitive job market, and a large number of you have significant student loan debt. That can make it very difficult to obtain financial stability. You add poor money management on top of that, and that can lead to debt, it can lead to stress, and it can lead to dependency on others. So learning financial planning basics now will really help you in the future, and your future self will thank you, I promise. So some of the things that you want to think about, number one is really figure out what your financial goals are. Goal planning is a really important part of life, and especially when it comes to your finances. If you don't know where you're going, how do you know how to get there, right? Yeah. So figuring out what are your short-term goals. Do you want to buy a car? Do you want to go on vacation? What are some of your intermediate goals? Do you want to finish, do you want to go for your master's degree? Is there more education you want to do? What is your long-term goal, such as retirement? When do you think you might want to retire, and what might that look like for you? Once you get that set up, then you kind of need to think about how important are each of these goals. Is it more important for me right now to save for a vacation than it is for me to save for a down payment on a house?
That's what I was going to say. Sometimes you have to, as you're young, you're almost a little bit more selfish, and it's harder to sacrifice those short-term goals for your long-term goals.
Yeah, exactly. And so really think about which one is more important to you, and place some priorities there. And then we got to look at, how much do I need to save to be hitting those goals? What's the target? And once you have a clearer picture of that, that can then help you establish a budget to reach them, which takes me into my next step, which is building a budget. I know people hate that word. That is no fun. Everyone thinks it's so restrictive. I don't want to live that way. I want to just be free and do what I want. But it really is super important if you want to get started off on the right foot of building that budget. The way you do that is really pretty easy. You just take a look at all of your income, all of your sources of income that you have, and then you take a look at your monthly expenses and things that are fixed, like your rent payment or your mortgage. But also take a look at your discretionary expenses too, because we want this budget to be realistic. And you and I both know we're going to get a cup of coffee every now and then. We're going to go to happy hour. So build some of those things into your budget so that it can
make sure you're still having fun.
Exactly. You want to make sure, because if you don't and you get too restrictive, it's just going to be too hard to follow. And then what's the point of really doing that? So you're building your budget. Then when you look at what your income is, you look at what your expenses are. Now we want to kind of compare the totals. Are you spending more than you earn? If you are, figure out ways you can kind of scale back on some things so that you're, not doing that. But you might find that you're earning more than you spend. And so if that's the case, get into the habit of paying yourself first. Establish either an emergency fund, start building your retirement savings, something along those lines, which brings me into the third step of financial planning basics, and that is establishing an emergency fund. Financial crisis happens when we least expect it. We don't plan for these things. We don't know when our car is going to break down. We don't know when all of a sudden our roof's going to start leaking. Things happen. We don't know when we might lose our job. So building an emergency fund, and the rule of thumb really is about 3 to 6 months of your living expenses, which you'll know what that is because you just built a budget, right? So that's why we go in these steps. But it's there to protect yourself and to protect the goals that you've set up for yourself, because if an emergency happens, and say you've been setting aside money for a down payment on your home, but you haven't built up an emergency fund over here, you're going to probably take that from the down payment fund, or you put it on a credit card, pay interest. It's never ending. Not a good thing. So that leads me into my next step, is be super careful with credit cards. This can lead to more spending than you can really afford. And I get it. I know when you're in college or even right outside of college, they hound you with credit card offers, and it's so easy.
Multiple envelopes every day.
Every day, and it looks 0%. And don't fall for it. Try your best. I mean, credit cards have their place, and we're going to talk about that in a little bit. They're not evil by any means, but just be very, very careful with them. And when you do get those offers in, read those terms and conditions carefully. Look at what the interest rate is. Make sure if it's offering you like a 0%, okay, but does it jump to 24% next year? You know, what's the fine print on that? Look to see if there's any hidden fees. Is there an annual fee? Are there going to be late payment fees? If you're late on a payment, are they going to jack the interest rate up? And if you want to do a rewards card, that's great, but make sure it's rewards that are going to benefit you. So if you're racking up air miles, but you never plan to travel anywhere and you don't like to fly, probably not the best card for you. So, and then do your best to pay the cards off fully each month, or leave a small balance. Don't let that get out of control.
Don't just pay the minimum for sure.
Do not just pay the minimum. You will. It's built to never be able to pay off if you just pay the minimum, and you'll be paying on that for the rest of your life. So, and then the final thing is take a look at your existing debt. Like I mentioned, you know, people in their 20s, 30s probably have some student loan debt, more than likely if you've gone to college. Make sure you pay those. Don't be late on the payments. If it's becoming hard to make those payments, consider doing a consolidation loan. Check into some income sensitive repayment options. They are available for you if you're struggling to pay them. And then beware of borrowing for new things, you know, or just becoming more in debt for anything. Ask yourself some questions first. Is this really necessary? Do I really need to go into debt for this? Have I comparison shopped to make sure that I'm getting the best deal possible? Don't just go with the first option. Make sure you consider how much loan is this going to cost me over time. It's really easy to say, okay, I'm borrowing this month, my payment's only this much a month, this is easy, I can handle this. Well, yeah, but you might be paying on it for 7 years. You know,
I think that's one thing, especially that I've noticed with my age, is everything is based on a subscription model now. So we only think about how much it costs us that month. We're not thinking about the fact that we may be paying $20 for something that would really only cost us $300, and we're paying for it over 3 years. And I mean, it's kind of we've been that's been beaten into us it's kind of only thinking about the monthly cost versus the annual, or every 5 years and everything like that.
Yeah, absolutely. So really look at that. Take a look at it. And if you're borrowing from a bank, that's one of the things that they're going to be required to show you is what this loan is going to cost you over the term of the loan. So that is available to you. So make sure you take a look at it, and then make sure you can afford this new monthly payment in your budget. I mean, you can $20, $30, $40, $50 yourself to death in a budget. You think, oh, it's only $20 a month, I can handle that. Well, if you've got 6 or 7 of them, that racks up. And so make sure you really can afford it, and ask yourself, should I wait to borrow until I've paid off another debt? Is this something that I really have to have today, or can I eliminate this debt first before I get into more debt? So those are really the basics. Obviously, there's more to it than that, but for today's talk, that's the basics, good things to kind of live by.
Awesome. Well, I think that from the first point with a budget, my wife and I started doing a budget, and we use a service called Mint that kind of links to your bank account, and that it's got graphs and everything, and it's been very helpful. What we realized from our budget was we spent too much money on food. Every single month there was a lot of money wasted on food. So we started to pull back from that, and that's how we built our first emergency fund when we got married, was just not eating out. And then once you get that 3 to 6 months built up, then we started for the car and then the house, and it took some. I like to spend money, so my wife is the saver.
Well, and it does take time, and I think we are all accustomed to the microwave society where we want to pop something, in the microwave and it's ready in 30 seconds. We don't want to wait. That delayed gratification, we don't like that. And that a lot of times will play over into our financial lives as well. But, there's something to be said for a pot of spaghetti sauce that has slow roasted for 4 hours on the oven. It's a whole lot sweeter and a whole lot better than something you zap in the microwave for 30 seconds.
Yeah, I'm a big fan of ramen noodles, though.
Yeah.
And they're really cheap.
They are cheap.
But, all right, well, so I guess we'll just go ahead and start covering some of the questions that we got. One of them, or the first one being, is what age do you think we should start investing?
Yeah. So really, as soon as possible. But make sure you have your foundation built first, like we just talked about. Everybody knows building on a firm foundation is a whole lot better than building on a shaky one. This goes for your finances too. And actually, one of the things that I brought with me today, I figured this would probably come up, but this is a financial planning pyramid. I don't know if you guys can see it on here. Some of the things that I'm talking about today, we can get these out to you. Just let the chamber know if you want it, and we can email those to you, and you can have a better look at it. But in the foundation of the financial planning pyramid, the very first thing, and I use this all the time, especially with my younger clients, is that you have your 3 to 6 months living expenses saved. You want this in a liquid investment, which would be like a checking account or a savings account, something that you can, get to very quickly. There's going to be very little return to that, but there's also no risk. And the reason why we recommend it, and I think I just talked about this though, is, if you get this out of order and you start saving for your retirement first, just like if you start saving for your down payment first and an emergency happens, the last thing you want to do is pull from your retirement account, because you probably know this, but you're going to get hit with a penalty and you're going to have to pay taxes on that. So getting this in the right order of establishing that 3 to 6 months emergency fund first is really critical. And then once you've kind of got there, then the next thing that we look at really is protecting those assets that you've saved and protecting those goals and that life that you're building with your family, especially if you have other people that are depending on your income. This is super important. You want to make sure that if something happened to you unexpectedly, either through death or disability, that your family is still taken care of, or that if you don't have family, if you are suddenly become disabled, that you're taken care of. We're really, really good at protecting our cars and our homes with insurance, right? Mainly because the bank makes you do that. But what good are those cars and what good is that home to you if you don't have an income to make the payments on that car or that car insurance or that home or that, homeowner's insurance? So making sure that you have life insurance set up to protect your family or whoever might depend on you, making sure that you have disability insurance in place in case you were to become suddenly disabled, so that you can still protect.
Well, and a lot of that can be found through your employer as well.
Yes,
So.
yep, absolutely. And that's usually the first place that when I talk with my clients is taking a look at the benefits that are offered through your employers. Sometimes you do want to have some supplemental, because if you were to lose your job, you lose those benefits too. So, but those are things that you definitely want to look at. So when you kind of have that level, that foundation built, then you can move up to the next level. And that's when you start, talking about a retirement account. And then we can move up to the next level that you're going to build over your foundation. And so the earlier you can start investing, the earlier it is for you to reach your goals. For example, and this is something that we can provide to you as well. It's a little graph, and I think it's really super effective. And I don't know how well this is going to read on the camera, but if a 25-year-old starts saving with the goal of hitting $100,000 by the time he's 65 years old, which sounds like a ton of money, but for that amount of time, it's not a ton of money, but it's still a good amount of money, $100,000. But if he starts at 25 years old he would only have to set aside $38 a month, invest $38 a month, assuming that you're getting an average rate of return over time of 7%, which is a fairly average rate over time, because you're talking 40 years.
Yeah.
Now, if you wait until you're 35, that $38 jumps up to $82 a month in order to hit that same goal. So it more than doubles. If you wait until you're 45 years old, that jumps up to $178 a month. And if you wait until you're 55 years old, which, believe it or not, I see that a lot. I will have a lot of clients that come in their mid 50s to early 60s that haven't really started doing any kind of planning for their retirement. And it's really sad. It can still be done, but it's a struggle. They would have to set aside $580 a month in order for them to hit $100,000. And that's mainly due, the vast difference between that is due to compounding interest.
Yeah.
It's extremely powerful.
Yes.
So the earlier you can start, the better. But again, you want to make sure your foundation is laid first. And, you know, considering kind of where you are in your financial pyramid.
So, and one thing that we did when we were starting our investments was, and I think this is kind of a requirement from your financial advisors, to do a risk analysis quiz.
Yes, sure is.
And so my risk analysis quiz basically came back to where I was the most risky and my wife was the least risky.
Oh, nice.
So-
That's fun. That's a fun conversation.
Yeah. So we, I mean, we hashed it out and kind of met in the middle, but that's one thing that I think is, you know, important to realize, that you were talking about an average of an 8% return, and depending on how you invest it and what kind of portfolios you invested in, you can, you know, have a larger return, but you're also at risk of losing that money. So it's always safe to kind of make sure that, think about it from a long-term standpoint. You're thinking over the next 40 years or the next 30 years. It's not a get-rich-quick scheme. It's you're trying to take care of yourself when you're older and you're not necessarily able to.
Absolutely. And you bring up a great point. When you're younger, you tend to be more risky. And that's okay, because you have a long time, you know, to weather the valleys that you're going to face in the market. And what typically we see with clients is that when you're first starting out, it's okay to be a little more aggressive in the market, but then you dial that back as you get closer to retirement. And so over the long term, you know, you might have a 7% average return, but you may be earning 23% on the front end, but then towards the back end, when you're getting closer to retirement and you're pulling out of the market, you're not being as aggressive, you might be only earning 3 or 4%. So over time, a typical average, you know, is 7-8% return in the market.
So the next question we had was, how much money do you suggest someone, I guess between the ages of 25 to 30, start investing? Not just putting into their savings, which is a little bit less of an investment, but whether or not they should max out their 401k at their employer or with their employer, or you know, kind of the monetary amount that you think is necessary.
This is a great question. I love to get this question. Like I mentioned before, 3 to 6 months, if that's my mantra today, 3 to 6 months of your living expenses in your saving account that you do not touch unless it's a true emergency. Then do what you can within your budget to get a good start on that first. In regards to like retirement savings, I have some targeted savings rates that, depending on what your income level is, you know, what you should really, you know, be looking to put aside. And that is, and again, I can share this with you because I know we're talking a lot of numbers today. A rule of thumb is to have 8 times your annual salary saved at your full retirement age. The average right now is 67 years old. That's when we're seeing, although that's creeping up some, the average age that people are retired. But so at age 25, if you start, if you're in a position to be able to start setting aside money for retirement, putting aside 8% of your annual income is a really good place to start. And if you start that at 25 and maintain that for the rest of your life until you retire, you're going to hit 8 times your annual salary by the time you hit your retirement age. And it's a good rule of thumb. Of course, it's going to depend. Some people might want to do more in retirement than others want to do. So that's a good rule of thumb to look at. Now, if you are waiting until you're 30, that jumps up to 11.1%. 35, it goes up to 15%. So again, going back to that power of starting younger, can really help. But this kind of leads into the second part of that question, is about maxing out your 401k. So most companies that offer 401ks also offer matches in the 401k. So it's possible that you might not have to set aside that full 8, 11, 15% out of your own money. You can contribute into your 401k and then let your employer make the match to kind of get you there. As an example, if your company matches 50 cents on the dollar for the first 6% that you contribute into your 401k, then if you contribute 6% of your paycheck, they're going to throw in 3%, and now you're at 9% going into your retirement account. So at age 25, you're there.
Yeah.
So that 3% is basically free money that your employer is just giving to you. You would be crazy to turn that down. So I don't necessarily recommend maxing out your 401k, because that's right this year, that's $19,500 going into your 401k. Don't necessarily recommend that, but I definitely recommend doing all you can to max out the match that your employer. Take full advantage of that. Anything above that amount, it might make more sense to put that into an IRA. The reason being is typically in a 401k, you only have around 20, maybe 25 investment options for you to choose from within the 401k. Whereas with an IRA, it's completely wide open to you as to what you can invest in. So, but you would definitely want to sit down with a financial advisor to talk about that, because there's lots of things that you want to consider. There's things in your plan that you're going to want to consider. That's just going to be too lengthy for us to get into before you make that decision. And I would be remiss if I didn't mention the tax benefits of contributing into your 401k. When you contribute to your 401k, it's payroll deduction, and it is pre-tax dollars that's going into your 401k. So, for example, if 6% of your monthly income is, say, $100, because of the tax savings, it's not going to feel like $100 coming out of your paycheck. Depending on how much you're having withheld, it's probably only going to reduce your paycheck by about maybe to $80, $85 rather than the full 100. Then you tack on that 3% match from your employer, which would be $50 additional. So now you're setting aside $150 into your retirement account, but you've only reduced your paycheck by about $80 or $85.
Yeah.
That's huge. That's like a 75% return right off the top. So I definitely recommend, if you can do it and if it works into your budget, is contribute, max out the match in your 401k. And then also kind of some things like some checkpoints to know if you're on target, like to kind of take a temperature of where you are with your savings. By the time you are 30, you should have to be on track, and I hate to use should, but something to kind of a litmus test per se. About half of your annual salary in a retirement account, you're on track, you're in good shape. By the time you're 35, about 1 times your annual salary. And by the time you're 40, you should have around 2 times your annual salary in your retirement account. If you're not, that's okay. You have time to make up for it. But if that's where you are, then know that you're in good shape to hit that 8 times your annual salary.
Yeah, and I would say for the 401k, just like you mentioned with credit cards, make sure you read the fine print, because every employer is going to have a different type of 401k.
Yes.
And determining on how long you have to stay with the company before you can cash out, and and everything like that. So
Yeah. Typically, your contributions are always going to be 100% vested because it's your money that you put in, but their match, that might not be vested right away. And a lot of times employers will use that as a way to keep you.
Yeah.
You know, it's not in a bad way. I mean, it's just an incentive for you to stay with the company longer because they're investing in you. They don't want you to just turn around and walk out with that
Walk out
money.
the door, yeah.
And so sometimes, it might be a year before you can get their match, or there might be a tiered. So yeah, it is really good to take a look at your 401k plan and read the fine print.
Awesome. All right. So the next question we had come in was about student loans, which you mentioned. We have a lot of student loans, or my generation has a lot of student loans coming out.
Yeah.
So kind of just ways that we can pay it off quicker and be more responsible. I know there are places where with student loan forgiveness based on your job and everything, but those are few and far between, and they're usually centered around the medical field.
Yep.
So just kind of some of your points on how to get that down quicker.
Yeah, absolutely. So, and I know this is a really hot topic with young professionals. I think the average student loan debt in 2020 is over $37,000 per student. I know some that are in the $200,000. So it's a big range. Average rate for federal student loans is around 4.5%, whereas the private student loan rates range around 3% or so. But really a quick answer to the question is if you can pay more than the minimum payment amount. I know that kind of sounds really super simple, but that's one of the really good ways if you can fit that in the budget. Also, if who you have your student loan with allows you to do this, you can pay biweekly. And if you do that, if you split your payment in half and pay it every 2 weeks, by the end of the year, you will have made one extra payment. And that adds up over time.
Yeah.
So that's something that you can do, especially if you get paid every 2 weeks. The one thing you just want to make sure is that when you do that, you're getting both payments in before the due date, because you don't want that to slip up on you and cause a late payment. If you have multiple student loans, some of the things that you want to think about is you really make sure you know all the details of each of your loans. You want to know is it federal or private, because there's some big differences between the two. Is it a fixed rate or is it a variable rate? Those are the scary ones to me. I don't like not knowing what that rate is going to be. Understand what your balance is for each of those loans, what the actual rate is, and then how long the term is, and what your balance is, what the total due with interest is, not just the balance, but what it's going to look like with interest. So once you kind of have those details, you can figure out which one you want to kind of start attacking first, because obviously the one with a higher interest rate is the one that you're going to want to make the extra payments on if you can. You may also want to look at consolidating or refinancing. A couple of reasons that might come in handy is if you are struggling with your payments, you can, do a refinance, possibly get a lower rate, stretch the term out, and, make those monthly payments easier. Obviously, that's not going to have you pay it off quicker or be more responsible, but if it means that you're going to be able to make those payments and not be late on them, that's being responsible. But you also can possibly refinance and get them all to a lower interest rate. The only thing that you need to be careful with on that is if you do go from a federal student loan to a private company, you are going to lose the benefits that come with a federal, the borrower benefits. Like for example, right now student loans are on deferment, which is nice because it means you don't have to make your payments and it's not accruing interest onto your.
Should still be saving that money though.
Absolutely. If you're not financially impacted, I 100% recommend that you still make those payments. They're accepting payments. They're just not making you pay, because by doing that, 100% of that payment is going straight to principal. None of it's going to interest. So you're going to reduce that balance so much quicker than if you wait until January, if that's when they start it back up again. To make those payments. So if you can afford it, do it. Or if you've got some high interest rate debt elsewhere, take that payment that you were making on your student loan and start making a bigger impact on that high interest rate debt.
Yeah, and that's one thing. So with my wife is a pharmacist, and I got my master's, so we had more student debt than the typical kid our age.
Yeah.
And so it's been really helpful. I mean, we were on like the 10-year plan, so we put a lot of money towards it. But it's been helpful right now not having to make that payment. And we're kind of considering, we've just been putting it aside in a separate account, and we're thinking about whether or not we're going to do a lump sum at the end of the year, just to go ahead and knock it down, because interest is high. I know you said the average right now is 4.5
on federal. Yeah.
So
2021 student loan debt that is going to be 2.57%.
Yeah.
For the
ours
new.
is 6.8.
Ouch.
Yeah.
That hurts.
Yeah, it does hurt. It hurts a lot, but yeah, I mean, I think that's a thing that's near and dear, and one thing that I would encourage people to think of is a lot of what you hear in the media and with everything going on is student loan forgiveness, and it comes up in Congress and whatnot. My personal thought on it is, you can't rely on that as a way out. You just have to, kind of put your head down and pay towards it, and you can't just think that it's going to go away one day.
Right. It's not. And putting your head in the sand and not making the payments is just killing your credit. And number two, you won't get out of it because they will garnish your Social Security benefits.
Yeah.
They can't do more than 20 or 25% of your Social Security benefits, but they will get it back eventually. You can't hide from Uncle Sam for too long.
No, you can't. And you just talked about or mentioned credit, and that's one thing, coming out with that much debt is how do you build credit? Because one of the major ways that I know of building credit is borrowing money. So do you have any tips or anything on that?
Yeah, absolutely. So I hear this a lot too, especially from my younger clients. They're struggling because a lot of them took some of those credit card offers in college, and so they're already coming into it with some blips on their credit, and they're looking for ways to build that back up. Or just some that have no borrowing history whatsoever. How do we get started on that? Because banks tend to get a little leery if we really don't know what your repayment history is like. We don't know how you're going to repay us because nobody else has lent you money before. So a lot of things that one of the things that you're going to hear about when you're looking at building credit is your credit score, what your FICO score is. And basically, there are credit reporting agencies out there, Experian, Equifax, TransUnion. They all report through a software this number, and it's called your FICO score. And it's this magic 3-digit number that banks look at, and they say, okay, based on this number, we know that they're going to be a good credit risk. So to put it in perspective, if you have a 700 FICO score or higher, I think 830 is the highest that it goes, or maybe 900. But if you have 700 or higher, you're probably you're cream of the crop. You're going to get the best rates from that bank. You're going to get approved. If you're between 700 and 620, you're still probably going to get approved, but you're probably not going to get the best rate out there. If you're lower than 620, it's going to be difficult for you to find credit. And so that's when you're going to need to start building that back up. So some of the factors that go into those credit scores and some of the things that you don't want to do, because this is what's going to negatively impact your credit, is number one, be late on a payment.
Yeah.
I mean, that's huge.
Pay your bills on time.
Pay your bills on time. One late payment can really take a significant hit.
And with technology, it's just set it on automatic and forget about it.
Yeah,
just make sure there's enough money in the account.
Exactly. Exactly. The other thing is, maybe not having enough credit, like we mentioned. The lenders don't know what your history is. Having too many credit inquiries can actually negatively impact your credit score. So if you are loan shopping or car shopping, auto dealers are notorious for this. Well, they will run your credit a bunch of times. That's an indication to the bank that you're shopping and maybe you're getting turned down at all these places. And so that's going to negatively impact your score. And errors on your credit report. that you really should be looking at your credit report at least once a year. You get a free report every year from each one of these companies. You just have to go to their websites and make sure there's nothing on there that's wrong. Either a bank or a credit card company falsely reported a late payment, or somebody stole your identity and has opened an account in your name. So super important.
That becomes more and more with all the online shopping that everybody does.
Yeah.
We got a letter in the mail yesterday about a hack on something that we had bought online. Now, granted, they offer, a lot of those times they will offer a free credit report and I guess financial or identity monitoring.
Yes,
so
yeah.
definitely take advantage of that.
Absolutely. So if you go in and you don't have enough credit, and that's one of the reasons why your credit score is low, some of the ways that you can build credit is check with your bank to see if they offer a secured credit card. And the way this works is you put like $500, maybe $1,000, whatever you want your credit limit to be, in a savings account, and the bank offers you a credit card that's tied to that savings account. Those funds are frozen. You can't get to them. You can't use them, but you can use that credit card responsibly, make your payments on time, and eventually the bank will get comfortable enough with you to release that savings account. But at first, they're comfortable with you using the credit card because they know if you don't pay it, they just have to take that money from your savings account and they're covered. So that's one way that you can kind of build your credit is see if your bank offers a secured credit card. Honestly, in this day and age, if the only reason that you don't have great credit is because you don't have enough credit, you'll be able to find a credit card company that's going to offer you a credit card. But just make sure that you're paying that back on time. Another thing is, don't max out those credit cards. Try to keep it at around 30%. So if you have $1,000 credit limit, try not to have much more than $300 on that card, and try to pay that off in full each month if you can, if you do only carry a small balance. Lenders don't like to see you maxing out your cards. They also don't like to see you having a lot of cards, even if there's no balance on them. So maybe you go into Ulta and you get a store card there, or Kohl's or Belk's, all these places that offer store cards. Those are still considered credit cards. And having a bunch of those, the lender has to assume, well, at any moment, he or she can go out there and max out those cards, and now is she going to be able to repay us with that? So owning 1 to 2 credit cards is plenty.
Yeah, awesome. Well, those was all the questions we have. I don't know if there's anything else you'd like to cover.
I don't think so.
Awesome.
I'd love to go in further detail with anybody that wants to sit down and set up a financial plan. That's what I love to do. That's where my passion is. So.
Awesome. We appreciate it. So again, this is Deanna Smith, a certified wealth strategist with Investment Center at CBC Bank. We want to thank you for coming out and helping us here with good coffee and coffee and connections and the Valdosta Young Professionals.
Absolutely. Thank you.
Thanks.